Hello and welcome to Moneylife News and Views. I am Debashis Basu. Over the years, the Securities and Exchange Board of India has issued many circulars and guidelines to regulate market intermediaries who deal with retail investors such as stockbrokers, portfolio managers, investment advisors, research analysts, etc. However, if the sole focus is compliance, disclosure and reporting, regulation stops serving the interest of customers. Let me focus on just one issue. Who can offer buy-sell advice to investors? Sebi's regulatory architecture has correctly tried to create distinct classes of regulated entities defined by type of activity. For example, only mutual funds and portfolio management services can accept money and invest on behalf of customers. Similarly, for decades, only one regulated entity, which is stockbrokers, have been offering buy-sell investment advice to retail investors. In 2013, for the first time, Sebi created a new class of regulated entities called registered investment advisors, following it up with another class called research analysts in 2014. All three can now offer buy-sell recommendations on stocks, which is what most retail investors look for. Unfortunately, it's not clear why three entities are allowed to do the same job. From the investor's perspective, it is also unclear what distinguishes each of them from the other, and advisors themselves are confused. Almost 9 years after the IEA and RA regulations, that is investment advisor and research analyst regulations, were introduced, most investors and advisors were unaware that research analysts can recommend buy-sell on individual stocks but cannot offer a model portfolio of securities. Advice through model portfolios were never explicitly prohibited under the RA rules. Hence, RAs offering model portfolios mushroomed. Why there is even a flourishing platform called Small Case, which is supposed to be the Amazon of stock advice, where hundreds of model portfolios are on display for the public to subscribe to. To the shock of the investing community, on 6th May, Sebi published a settlement order with a research analyst entity. That entity was hauled up for offering model portfolios, which is apparently disallowed. A former executive director of Sebi, who headed the legal department, joined issue on Twitter, arguing in a detailed thread that the regulator's order was incorrect. Meanwhile, in a completely contrary stance, at least two individual RAs who openly stated in their applications that they were going to offer model portfolios as research analysts were actually approved by Sebi. And they were cleared by Sebi for doing this. So there is no clarity inside Sebi too, whether RAs can offer model portfolios. The analyst who was hauled up said he paid up only to avoid expensive and prolonged litigation that would have hurt its business much more. Now, let's look at brokers as investment advisors, the third class. Since 2016, Sebi issued many rules to prevent unauthorized trading by stockbrokers. Yet, one comes across dozens of cases of blatant overtrading in client accounts every year, leading to massive losses for certain kinds of investors. Many are backed by sham technical compliance on the part of brokers. The biggest names in the broking business, many of them listed, are repeatedly hauled up for serious misdemeanors which remain hidden from investors since arbitration and grievance redress orders are tagged as confidential. Even the biggest rogues among RAs and IAs cannot match these misdemeanors because, unlike brokers, they have no access to clients' funds. Consequently, employees of broking firms pose as derivatives experts to generate massive loss-making trades by targeting senior citizens or less savvy customers. In one case, a super senior citizen investor who has never traded more than 5 lakhs a year suddenly was encouraged to do derivatives trades of 1.32 crore in 2 months, and a mere 255 rupees credited to his accounts as earnings and no explanation. The total trades were over 6.25 crore. The broker ensured technical compliance with the regulations, that is margin and ledger statements, emails and SMS messages. The unsuspecting senior citizen was tutored to place specific orders for transactions he did not understand on calls from the broker. Soon he was selling his core portfolio to meet debits. In another case, a broker verbally promised to help an investor earn a steady return every month by selling call and put options on Nifty. He handed over his entire investment portfolio of 1.25 crores spread across 57 scrips, many of them blue chips like Hindustan Lever, Asian Paints, Pidilite, Procter & Gamble, Dabur, etc. This strategy earned some returns when the market was steady, but when the market crashed, it inflicted huge losses. The brokers sold out the blue chips, which were the life savings of the retiree, to cover the losses. Such stories are too numerous to pretend that the broker is blameless, but they go unpunished. So what is to be done? Let's go back to the basic principles. What investors look for are buy-sell recommendations. Of the three sets of regulated entities, brokers, RAs and IAs, who is best placed to provide this? Until Sebi was set up, stockbrokers were the only market intermediaries and they performed multiple functions. Then came specific regulations for each market intermediary. Banks, depositories and custodians handle transacted assets, and portfolio managers and mutual fund manage investments. Their role is clearly defined, but it is time for a fresh look at the business of advice for retail. Although stockbroking is highly regulated in the past 20 years, malfeasance, horrible advice, bad faith, incompetence and outright fraud are not uncommon. Brokers ought to be only a means to execute trades, and they have a monopoly on that activity. They ought not to be allowed to offer advice because Sebi has created two other intermediaries for this, which is investment advisor and research analyst. So such a move will ensure far greater accountability for advisors. That still leaves us with the confusion about how to differentiate between the role of RAs and IAs as regards buy-sell advice, which is what customers need. This can also be resolved with a simple principle. Any buy-sell advice, including a model portfolio of stocks or equity mutual funds, should be the domain of RAs, that is, research analysts, and holistic financial planning and asset allocation should be the domain of investment advisors. If you like this, share, like, as well as subscribe to our videos. Thanks for watching.